Warren Buffett's Berkshire Hathaway just keeps buying back more stock. And this is really interesting because Warren Buffett is one of the greatest investors of all time, multi-decade career generating returns around 20% annualized. And he was rapidly buying back more Berkshire shares during the first quarter. And so this means that here it is, a great capital allocator is saying, hey, I would rather own more of my own stock right now because it's meeting his own hurdles. Now, is this potentially an opportunity for investors to tag along and say, hey, if Warren Buffett thinks it's compelling at this price, maybe I should tag along as well? What are the potential range of possibilities for the returns? What's going to drive the stock price going forward? I'm going to talk about all this and more. If you enjoy educational investment videos, please make a point of hitting that subscribe button. You're watching Unrivaled Investing. So let's dive in. You see around $4.5 billion worth of buybacks during the first quarter, around 1 million B shares purchased in January, a little under 1 million in February, and then they rapidly scaled it up to 4.5 million in March. Now it's interesting, it's around 310, the million shares, closer to 300. So he clearly thinks that the price around 300 for the B share is a lot more compelling. It is a little bit higher now, but it does give you a frame of reference for where, it needs to be to get that, to pass that sort of hurdle that Buffett's looking for. And so $4.5 billion purchased during the first quarter versus all of 2023, around $8 billion. So on a path to well past the repurchases last year. And this is interesting also because, look at the prior years, he's been buying back a ton of stock, around 27 billion the year before, around 24 billion the year before that. So Berkshire Hathaway just continues to cannibalize its own shares. Now, when we look at Berkshire's results in the first quarter, you see around $5 billion in free cash flow. That's a bit better than where we were last year. Now, what was he doing with this significant cash flow? And this is, keep in mind, this is spread across dozens of different business segments, and you get a clear picture of what Buffett's doing based on this. You don't necessarily see exactly what stocks he's buying. There's a little bit of a delay on that, which, when that comes out, I will post it. But you can quickly see what he finds to be compelling roughly. And so here it is with $5 billion of cash coming in. Well, he actually bought only $3 billion worth of stock, but sold $13 billion worth of stock during this quarter. So he was a net seller of stock to the tune of $10 billion. That's a clear signal, in my opinion, that he's saying, yeah, for Berkshire Hathaway, the big companies out there that he could potentially buy, he's just not seeing the value. Now, this is in stark contrast to last year first quarter where he bought around $40 billion worth of stock. So very different signal last year versus this year. This year, he's actually selling his stocks. Then you look at his bond portfolio, and net, he was a buyer of around $7 billion. So this is signal because he's not only saying, it's not only a signal on stocks, but he's also saying relative to the return I can get on short dated US treasuries, getting 4 or 5%. Heck, you can get, 4.5% plus on cash. I personally keep my account at Interactive Brokers. And he's saying I can get a much better yield just holding cash, and I'd rather wait for the fat pitches. And he's not really seeing that. If anything, he's lightening up on his stock portfolio and buying more treasuries, even with the risk of, a default, the U.S. debt ceiling fracas that you see. He's saying, hey, you know what? They're going to get that job done. That's at least, based on what he's doing with his portfolio. And by the way, I'd rather collect that 4 or 5% on treasuries than buy more in terms of stocks that he doesn't really have high conviction in. And then he also spent around $7-8 billion on buying more of Traveling J. That's one of their subsidiaries that they own, buying a greater percentage of this business, and also this $4.5 billion in terms of buyback. So you can quickly see how he's allocating, the capital in Berkshire Hathaway. And it is really interesting. I mean, once again, this is not like he has a small cash portfolio. I mean, this is a huge amount of treasuries that he has. As of the end of the first quarter, he had over $100 billion just in U.S. treasuries. Throw on another, 20, let's say 25, 26 billion in cash, whether or not it's in insurance and or the various different, industrial subsidiaries. So he's rather pile on more cash than add to his $300 billion stock portfolio. Really important data point. Now, when you look at their underlying earnings, it's actually a mixed picture. If you look at insurance was up around $2 billion from a pre-tax operating perspective. This was really driven by Geico, their auto insurance business. They made clear during the call, Ajit Jain, who runs insurance, he made clear that, Geico's sort of going through a process of readjusting some of their policyholders where it's effectively raising prices where they may not grow their business, at least in the near term, and they want to make sure they cut unprofitable business. And this period also included a one-time gain from previous insurance, underwriting that turned out favorably for them. So there is a bit of a one-time gain, aspect with Geico. They're not expecting it to grow significantly, at least in the near term, but they expect it to be more profitable. And so you are seeing a significant improvement in profitability. This is a clear focus for management because Geico should be a significantly profitable business. But the key driver of their insurance business turning increasingly profitable goes back to that key concept of you're getting so much more for your cash nowadays. And so that's, he's getting $1 billion more on his investment income primarily because interest rates are higher. And that's just such a beautiful position to be in. I mean, just think about that. If you have $100 billion, just round numbers, $100 billion in cash and short-term bonds, a few years ago, that was yielding close to zero. Now that's, you're easily getting an additional $4 or $5 billion a year just keeping that in short-term bonds. So that is a very beautiful position for Berkshire to be in, that extra cash, that extra investment income. When you look at their operating segments that are not insurance related, you have the railroad, you have their Berkshire Hathaway Energy, Pilot, which I already mentioned they acquired more of, manufacturing, McLean. Looking at these various different segments, by and large, a lot of them actually declined year over year. You saw a sizable one-time charge with energy tied to 2020 wildfires, but this wasn't particularly strong. I think during the meeting, Buffett even said that he expected his earnings for their core business segments could actually be lower, but broadly earnings across the board would be higher when you look at both a combination of the portfolio as well as the higher interest, driving returns. And so you're looking at this, you have strong showing from insurance, largely because of higher interest rates. Their underlying operating businesses down actually about $500 million year over year. And so all in before you look at any sort of investment gains, their core operating profits were up about $1.5 billion. You're looking around just shy of $10 billion per quarter. So a way to think about this is looking at their businesses, the cash that's coming in, you're talking around $40 billion pre-tax. That's an important data point. We'll apply it later in just a second when we're thinking about Berkshire's valuation. And then you get this really noisy aspect where you're looking at the change in their portfolio, and that flows through their income statement, which is their investments and derivative gains and losses. In one period, it can easily be a multi-tens of billions of dollar loss. In some periods, if the stock prices go higher, it could be a huge gain. In this quarter, you had a $34 billion gain on their portfolio, but once again, it's not fully recognized. It's not like it's recognized but not realized, I should say. They're not selling these investments, but it's primarily because Apple was up, something like 20% during the year to date or during the first quarter of 2023, and given that Apple's around 100, I think as of the first quarter was $150 billion position for them, very sizable position around that level. That's going to have a huge impact. And so that gain so far during the first quarter was primarily from Apple stock appreciating. But once again, it's not like he's selling it. It's not like it's the cash, that $40 billion in pre-tax cash that we're talking about here. This is sort of the noise of the portfolio changing in any given period. Okay, so where does Berkshire go from here? First, a quick plug, and in full disclosure, this is not financial advice. And I recently started buying a stock that I think is over 300% upside that I call out to my subscribers at unrivaledinvesting.com. We also offer educational videos and exclusive Discord server available for annual subscribers. So once again, that's on unrivaledinvesting.com. So when we think about Berkshire from here, the different components are, you have the pre-tax earnings, which I already, called out. That's around $40 billion. And you could see that, based on their most recent earnings as well as prior years. Then you look at their portfolio. Their portfolio is around $500 billion. That's a combination of their stock portfolio, that's $300 billion plus, as well as their cash and cash and, let's say, short-term bonds, another, around $200 billion when you're looking at that. And so looking at a portfolio all in a $500 billion, well, what's going to be the realized gains that you could get from this portfolio over time? And also think about that on a tax adjusted basis, after tax, what are the potential gains that you could be thinking about this? And so I personally look at this and, try to have a conservative approach. So I'm thinking high single digits, on an after tax basis, certainly for the portfolio. So when you look at pre-tax earnings of around $40 billion, you think about maybe a 7-8% return after tax on their portfolio. And then maybe on an after-tax basis, they're generating earnings, normalized earnings, recognizing the portfolio will be very volatile, of around $45 to $50 billion. That's what I'm currently penciling out. Maybe it's a little bit higher than that. You can have different assumptions. You just a change on the portfolio would have a big assumption, big impact on what you think normalized earnings could be. Apple will have a huge impact, on, for example, their long-term value creation here at Berkshire. So looking at Berkshire, currently around a $700 billion market cap. That's the $327 for the B shares. And so thinking about this normalized earnings of around $45 billion to $50 billion, this does imply that Berkshire is trading well below the S&P 500 and other major U.S. indices, which is trading closer to 20 times. And so here it is, Berkshire's trading at a full, you could almost say 25% discount to the market. No wonder Warren Buffett is finding more value in his own business, where he has more confidence in the capital allocation than, let's say, the broader index, where he's saying, hey, it's more expensive and I don't even control the outcome of that free cash flow. And maybe the growth prospects aren't even as good because, the capital allocation might not be as good. And so thinking about, okay, so what's going to drive this going forward? You have organic growth. This is not even thinking about the cash that can go to buying new businesses, but just think about the growth rate of these businesses. As I already mentioned, the first quarter, it sort of struggled, their profitability sort of struggled, but broadly, let's say 4 to 6% growth. Organic growth. It's hard to grow such a big business. This is largely tied to global GDP, particularly US GDP. Then what's the end multiple? I'm going to say let's say it stays around the current level. Let's say it stays in a range between 14 to 18 times some sort of normalized earnings. So that means 5 years from now, maybe the normalized earnings is closer to 60 billion, give or take. And then, you might say, well, Daniel, but wait a second, isn't there 20 to $30 billion per year in free cash flow that they could use to grow their earnings even faster than this organic rate? Well, I'm including that here in this annualized value accretion that I'm assuming effectively gets used for buybacks. And so maybe that's to the tune of 4% a year by and large, relative to that, if you're spending 20, $30 billion a year on free cash flow on buybacks and you have a $700 billion company, that's roughly what it checks out to be, this 3-4%, annualized, incremental value appreciation, for your shares. And so that's how I'm penciling out. And keep in mind, this is a hypothetical valuation framework. Of course, Berkshire Hathaway stock price can go way higher, way lower. But the way I'm looking at this is that over the next 5 years, you have this business that has, incredible cash, it has incredible cash production. So you have this hoard of cash. You have just so many different businesses that are just spigots generating tons of free cash flow. And then you have this huge portfolio. Now it is, heavily concentrated in Apple stock. So you have to have an opinion on that. I'm a bit cautious. I'm more cautious on Apple than Warren Buffett is. But I look at this and I'm thinking it wouldn't surprise me if Berkshire Hathaway stock compounds over the next 5 years around either a mid-single digit or a, low teens potential return over the next 5 years. And I sort of gave a framework here to think about it. Obviously a lot will depend on the fundamentals. If their execution is a lot weaker, if they don't deliver on that, let's say 5%, give or take, organic growth, or if the sentiment gets a lot worse and you get a lower multiple 5 years from now, that could certainly hurt the business. But I think a key aspect to consider is, one, Warren Buffett thinks the stock is compelling around $300 a share. That's, a little bit lower than where it currently trades. So that's a key data point to consider. The second point is that I think for any new investment, for an investor to consider, is you could have this incredible diversified basket of businesses run by some of the best capital allocators in the world, and the potential hurdle rate that you're looking at is, let's say, high single digits. And so any new investment that you consider, it should be sort of cross-checked against this to say, hey, the investments you consider that you're going to pull the trigger on, that you're going to say, this is worth putting much more of this in my portfolio versus Berkshire Hathaway. Using Berkshire Hathaway as a hurdle, say, well, this is just a great company. Why not buy Berkshire? And then you go, well, this other business, it better have this dramatic growth that's going to drive 200, 300% or 500%, upside potential over time. Maybe it's because it's a smaller business. Maybe it's just because it's growing faster, has a cheaper valuation, different dynamics like that. And then I think another key element, and the last key element that I think investors should understand and think about right now, is that, Buffett has been trimming stocks lately. He has been preferring to buy bonds. And that just goes further on that heavy pile right now, saying to me personally that you could possibly get better bargains in the future. When you have the greatest investors in the world saying, I'd rather just wait. I'd rather get my cash, get a nice yield on my cash, than buy more stocks that are potentially overvalued, potentially leaning into a recession where you might get even better deals with lower earnings, from these businesses. So I think, it's a clear signal to me that Warren Buffett, he's not trying to time the market. That's not it. He's just saying the values here. He'd rather sell stock than buy stock. And that's clearly the signal here. He'd rather get that 4 or 5% on cash. If this video was helpful for you, please make a point of hitting that subscribe button. Thanks so much for watching Unrivaled Investing.